But what I want to do is encourage everybody that's with us today to place your questions in that chat. We're also going to have some polling questions and things like that that we'll be asking you to engage with throughout the presentation today. But this is really about you. The folks that registered for today, we had some survey questions. I checked out those answers to those survey questions. It is included in the content of today's presentation. We want to make sure this is as meaningful for each of you as it possibly can and customize this as much as we possibly can. But at the end of the day, the only way you're going to know how all of this information fits you and your financial future is if you schedule an appointment with who invited you today. So without further ado, I'm going to wish everyone a happy Wealth Wednesday. And today in Real Secrets of Money, we are talking about financial protection. I think we are. Come on. Let me see why it's not advancing. Ah, ha, ha, there we go. It was absolutely user error, so I apologize for that. So on our agenda today, we're going to talk about why protection matters. We're going to talk about how to plan for and give you some tips and tricks on how to plan for the unexpected. We will get into some juicy bits about strategies and on stability, whether that's lifetime income, which everybody loves to talk about and know about, or tax advantage strategies. But really all this is about is taking control of your financial future. I do want to share that free consultation is linked to my calendar, and I apologize if I did not invite you and you're not here with me today. I want to make sure that you talk with that person that did invite you. So drop it in the chat, or they will follow up with you directly after today's session to make sure they take good care of you. So we take a look at financial protection, and we really are putting it into three buckets, if you will, or three categories to make it a little bit easier for people to manage through, understand, and for them to really plan for. And so that first pillar, or that first bucket, if you will, is your income. So your income is extremely important. We'll talk about that and why, and you can imagine why it's important, but we'll talk about that in a minute. But health also is extremely important. And when you think about our health and how expensive healthcare is, and when something happens to us, we want to focus on our health, not focus on figuring out how to put food on the table. And then legacy. Everybody's situation is a little bit different, and what their desires are to leave a financial stability for their loved ones. Easy for me to say, right? So that legacy building, how are you going to take care of your children, your grandchildren, and maybe generations to come? All right, so drum roll, please. This is our very first polling question. We're going to ask everyone that's on to join in on the poll. The question is, what percentage of Americans don't have financial protection plan in place to safeguard their assets? Is it 20%, 45, 60, 75? All right, we're going to wait for a few minutes for a few more people to chime in. Okay, we're getting there. We're getting there. See the poll moving a little bit. I think we are. I think all the results are in, and we have some smart people on today, and that is absolutely true. 60% is what the majority of our participants today thought was the case. So just think about that. 60% of Americans do not have financial protection plan in place. And that's heart-wrenching. That really is concerning, because you want to make sure you have a plan in place, absolutely. But I think part of that is because people believe that only those with a lot of money can have a protection plan in place. And that is just simply not the reality. All right. Okay, so striking the balance. I'm a visual person. This image isn't the best, but I think it does a great job at really sharing what what you have to worry about, right? Striking the balance. Okay, you're worrying about your income, but you need to leave a legacy. You're worried about and want to make sure you're growing your money as much as you possibly can, but you have to protect it too. Then you want to keep money for yourself, right? Money for you. You've worked really hard with that. And so then how do you make sure you're not giving too much to the IRS and you have some advantages on the tax side? So this is a really nice image that talks about that balancing act of those three areas. Remember, if you have any questions at any time, drop it in the chat. It could be on the slide. It could be something I say that makes you think of something else. Nothing is off limits. No question is stupid. We really want to make sure we have a good conversation for you today. So what is your most valuable asset? I don't think anyone is going to doubt that the answer is income. We have to pay our bills. We have to put food on the table. We have to do all of the things that we need to do in this life. And so income will always come first. When you think about how much income you have to protect, it's really, again, going to be based on you and what you have going on in your life and your children, your grandchildren, those types of things. But kind of on an average, if you think about 10 to 15 years. So if you take your annual gross income and you multiply that by 10 or 15 years, that's going to give you a really good base to understand what that protection need is. And if you think about it, we're protecting everything else. We're protecting maybe it's renter's insurance, maybe it's mortgage, maybe it's your car. We are already doing this in our lives. Why aren't we protecting the number one asset that we have? All right, so just some tips and tricks of things to think about as you're building that financial plan. Now, working with us as your financial coach, we absolutely will hold your hand and guide you through all of this. But this is to get you started. And if you haven't noticed, what we try to do is put things into 3 buckets or 3 categories, or maybe a simple list. So that as you're out there, you can really kind of take a look at these different components and almost simplify the process, because it can be extremely overwhelming. So the first is planning for your financial future, your secure future. And something to think about is diversification. So you don't want everything all in one bucket, and you want to make sure that you're receiving income from different ways and different platforms or different sources. When I talk about multiple streams of income, I'm not talking about the side gig economy, although that is absolutely a thing. And people do need in this day to fund their lives through multiple jobs. But what I'm talking about here are things like dividends and growth, cash accumulation. And so when you think about how you're going to be receiving your income, either some short-term experiences and needs, or those long-term. That's what I'm talking about here. Okay, so strategies for guaranteed income. People think about annuities and they think about there were parents' annuities with very low growth rates, and it was something that was just you put money in and you forget about it and you're lucky if you get 3%. That's absolutely not the case in today's financial climate. There's so many options right now for every generation to really tap into wealth building for sure, but also that guaranteed income stream. Social Security optimization is a thing, and a lot of people do not think about that. They think, well, I'll get Social Security 65, 67, whatever that looks like, but there's optimization tactics and strategies. And just think about all of the debates that are going on right now regarding Social Security. Don't you want to be prepared? So systematic withdrawals is also something to really think about. It's not just having that money and then I want this every single month. It's really making sure that you're funding the lifestyle in your retirement that you want and you need, but while still maximizing your money and mitigating your tax exposure. And how do you do that? Systematic withdrawals. So some additional considerations, whether you work with us or you work with someone else, you absolutely need to make sure that you review and adjust your plan on an annual basis. You want to make sure that you have some inflation protection. Long-term care is a big thing to worry about. As we get older, our health is definitely something that's at risk. We need a plan now while we maybe a little bit younger, maybe our health is a little bit different, so we can manage that later in life. Always thinking of tax liabilities is a big deal. People don't think they have a lot of control over it, and they do. And then the unexpected expenses, right? Because life happens. I always say it comes in threes. When two things happen, I'm waiting for the third, and it never fails me. It always comes. And protecting against that and understanding those, how to plan for those unexpected expenses. Again, any questions in the chat, drop it down there. We'll want to make sure that this is geared towards you and that we're having a conversation today. You're just not hearing my voice. All right. The next poll is here. So it says, when planning for retirement, which tax option saves you more money in the long run? Now I have to apologize. We have bullets here, but A is your first one, which is the tax deferred account, 401ks, IRA. Your tax-free accounts is B. You have C, both are the same in the long run. And then D is, I'm not sure, but want to learn more. So go ahead and start our poll answers as they come in. There we go. We got a couple people chiming in. Very good. We've got some smart people here today. I love it. I love it. We have some curious folks here today. I love that even more. All right. I see the numbers moving just a little bit. I think maybe they've hit, maybe. Yes, the poll is in, and the answer is B, tax-free accounts, Roth, permanent insurance accounts, and those types of financial vehicles. That is absolutely true. I love this poll because a lot of people are taught for tax deferred accounts are going to be best. And then as you have growth in those tax deferred accounts, you will be able to take care of any type of taxes that happen long term, because the thinking is that your income will be lower or there's some stability in the tax laws, which we all know there aren't. So tax-free accounts absolutely is something that will be good for you in the long run. So just a little bit of a fun exercise I like to give, and this is really bringing home what I just said as far as that tax deferred versus the tax-free account. So when you think about this, the 401k, 250,000 with 20 years of growth. I'm looking at a 5% annual interest for growth, just because it's conservative. Everybody can get behind that. If I gave you 20%, it'd be a crazy number, wouldn't it? So 5% annual interest for $678,000. So clearly, what we're wanting to look at is your tax obligation. Do you want to pay $62,500, or do you want to pay $169,500? This is simple math, obviously. I'm not sure if anybody on today is going to say, I would like to pay $169,500. If for some reason you're saying that's who you are, make sure I know who you are, and let's have a conversation after this and share with me your thinking. I'll share with you my thinking, and we will help each other out. How's that sound? All right, so another example, and this is really simplified. So when this is comparing a tax deferred versus tax free. So in this case, I'm really comparing something like a 401k, what you would get with your employer match, and then I'm comparing a index universal life, which people never think about for retirement plans, but they have a lot of features to them that are very interesting, and we always encourage people to check them out. So starting at age 29, growing at an annual rate of 7%, very believable. 401k, index universal life, growing at 7%. So as 29 years old, you've got some time to contribute to that account, don't you? So both people are in the same age, contributing for the same amount of time, the same amount of money. But remember, one has a company contribution, the other does not. And after 30 years, they're ready to retire. They are retiring at 68, and they're saying, okay, I want to, oh, did I click? Yes, I clicked. Huh. I want to retire at the 47.5. So here are the answers. The tax-free 401k with the company match and the company provided term life insurance. The annual withdrawals have to increase because you have to cover the taxes. And so you're not withdrawing 47.5, you're withdrawing over $63,000. And because that life insurance policy from the company was a term, it terms out. So you lose it. And so you run out of money in your 401k after 11 years. You've contributed for 30 years and you're running out of money after 11 years and you don't have life insurance to protect your family. And at this time you have you're at an age where you may not be able to qualify for life insurance or afford life insurance. And then under that tax-free option, which is an index universal life policy, which people don't think about here, look at what happens. You don't have the company match. You're still contributing the same amount as if you were contributing to a 401k. You could live to 100 years old. You could be receiving 1.4 million. You're not running out of money. And you've protected your family. You've given your family over $400,000 in life insurance. How amazing is that? Okay, so we do have a question from a gentleman or a person in the chat. We're gonna actually end the session today with that question because that is a question for our internal teams. And so we'll be able to answer that for you. Absolutely no problem once we stop the recording today. Thank you for that question. We'll get to you, I promise. All right, drum roll, please. Here we go with another poll on a scale of 1 to 5. How would you rate your current knowledge of life, disability, and long-term care insurance? All right, I have little to no knowledge, know the basics, but need some information, have a general understanding. I'm fairly knowledgeable and I know my stuff. I could be teaching the session today. All right, let's see our polling question answers. Coming in. Very cool, very cool. Okay, we have a couple of people here know the basics, but need some more information. We're here for you. We'll absolutely support you on our call today. And then absolutely want to schedule some time to talk very specifically about how everything impacts you. And we've got a couple people that have some general understanding, but could use a refresher. Love it. Fairly knowledgeable and confident in your understanding. Absolutely love that. That is so good to have you today. And I love to hear from you in the chat. If I say something different from your knowledge or belief, or you have a little bit of a tip and trick to share with us, we would absolutely love to hear it. All right. So insurance, the financial shield. Again, visual. Sometimes it's easier to learn when we are visual. And so this shield right here talks about illness, protection against illness, your life insurance protection. What if you're injured, or what if you have a disability that impacts your daily life? So think of it as an insurance shield. And so each of these areas, very important to consider in your planning process in the area of financial security and protection. Glossary of terms. So if you're wanting to get your knowledge kind of built, or maybe build your knowledge a little bit further out, there's a lot of terminology in financial services, as there absolutely a lot of terminology in insurance. So this slide is here to help you with all of that. A claim, you may already know, a claim is when you make a request to receive benefits from a specific policy. A beneficiary is somebody that your money will go to when you pass. Premium, that is something that is paid. It could be paid on a monthly basis. That is the amount due for the policy. It could be paid on a quarterly basis. And it can also be paid on an annual basis. Usually those are the typical payment terms. Policyholder, that is the person that owns it. And the deductible, that is a proportion of the insurance policy that you must satisfy. You must pay out of your pocket before the terms of those benefits go into effect. In a rider, this is something where there's some bells and whistles a lot of times that are added on, some features that are added onto the policy, and that is called a rider. Okay, let's hit on accident injury first. So accident injuries, they can happen. They can happen at any time. And we have absolutely no clue when this is going to happen in our lives. And that's scary, but we still have to live our lives, don't we? And so the protection for accident and injury, that's your risk. You know it's going to happen. It can happen at any time. What are you going to do financially if it happens to you? It's not just about covering any medical expenses you might have, but it's also, it could be that you have to cover your income. Maybe you have to cover additional expenses out of pocket for medical, not just your insurance expense. Come on, Lisa. There you go. Cool. And so this usually, what this does is it complements other insurance types that you might have in place. So if you are a full-time employee and you receive medical insurance from your employer, that can come into play. And then this insurance lays alongside that, so it can cover things that your medical just simply won't cover. Another thing accident insurance can lay alongside of is short-term disability. Depending on the accident, it could be long-term disability. In some cases, employers also offer these types of programs. And again, the accident insurance is going to lay alongside of it, because the insurance that is out there that you have through your employer, or you may have a small policy independent, it's not covering what you need it to cover in those times of need. It's unfortunately not covering. So you have to protect yourself. All right. I actually just look at that. I just hit on that. So another thing I didn't mention is there's a lot of cases there's not access to appropriate paid time off policies. So if you are with an employer that has a paid time off policy, sometimes those policies aren't enough to cover you financially. Sometimes workers' compensation, if you receive benefits, something happens, an accident through work, and you receive benefits, sometimes it's not complete and it does not give you what you need depending on the accident. And this can jump in and help you. So critical and chronic illness, very similar to accidents. So this is something in many cases we're not going to see. I mean, chronic illness, certainly there's some onsets there, but health in our lives is extremely important, because if we cannot properly take care of ourselves, what can we not do? We can't work. So we're living longer lives. Illness is impacting people more now than ever. I think we've seen the statistics on the news. I think we've probably experienced a lot of things ourselves. I don't think I have to convince anyone about critical or chronic illness. When it hits, it is absolutely important to focus on your health, not how you're going to pay your bills. And so having critical and chronic illness is essential for that peace of mind. And can you heal when you're stressed? Can you heal when your mind is on other things versus focusing on the best healthcare and the best treatment for you? You can't. So when you think about critical illness policies, just think along these lines. That's cancer, that's stroke, that's heart attack, major organ transplant, renal failure, and critical illness. So the policies are designed to cover those out-of-pocket expenses. As I mentioned, just like with accident and coverage, things happen. The other insurances and things that you might think that you have in place simply don't take care of what you need them to take care of. One of the things that people don't think about is the travel expense for treatment. You may have a family support that can get you to local treatment centers or facilities and those types of things. If you don't, you have to have transportation to those. And then what if the best care for you is out of state or out of city? How are you going to cover those travel expenses? Sometimes in other coverages, you have therapies that are capped. So if you have therapy or rehabilitation, you may only have so many sessions, or you want to go to the best of the best. And your best of the best is out of pocket or out of network. Childcare, home care, and some of those lifestyle expenses as well, to give you some more examples. Okay, so the protection, if you are unable or it impacts the 6 activities of daily living, like the bathing, dressing, eating, going to the restroom, transferring, just kind of movement from bed to chair, and continence, then that's what this coverage does focus on. So just think about what's going on in our world with Alzheimer's disease, Parkinson's disease, severe arthritis. When you think about that, we all have people probably in our world, whether that's family or friends, that either is going through this or their parents are going through this. And so you absolutely know how important chronic illness protection is. So living benefits. So this was when I jumped into the financial services industry, and I was really learning about all of the various financial vehicles. I was pleasantly surprised to learn about living benefits. And I wasn't alone, because as I'm talking to clients and potential clients and folks, they are also very surprised by living benefits. So living benefits are it is what I call a feature of an insurance policy that provides income for various chronic, critical, or accident types of situations that we just talked about. And I have a story that I like to tell. I'm going to do a time check. I think I can tell this story. I heard this from a gentleman in Florida, and it still gives me goosebumps. But a woman had an index universal life policy. We just referenced that earlier today. So this example is interesting. It aligns with that. But she had an index universal life policy, and she was new. She was new to the policy. She only paid a couple months into the policy, and she was diagnosed with cancer. And she was very aggressive cancer. And so she really had a lot of restrictions very early on from working. And she was very stressed. She could not cover her bills. She had to drop down to a part-time schedule at work, which even made that worse. And because she was new into this index universal life, and she's thinking, how am I going to pay the premium? I can't pay the premium. I need to call them and tell them what's going on. And so she contacted the carrier. She said, this is what's happening. Can I suspend my premiums? What do I need to do? Do I need to end my policy and start at another time? And they said, ma'am, we have some great news. And they shared with her the living benefits on the policy. So she received a check for over $114,000. And she was able to take a leave of absence from her work that, if you remember, she went down to part-time work. She was able to focus on her health, and she was able to get the treatment that she needed. She didn't have to worry about making her bills. And then she was able to get back on track with her life. So successfully battling cancer treatment. Can you just imagine how amazing that is? It absolutely saves lives. So living benefits is an incredible feature, a part of insurance policies that you should absolutely explore when you are building out your protection plan. Short-term and permanent disability. A lot of employers offer short-term, some offer long-term disability. That's a fraction of your salary for very specific periods of time. Every policy looks a little bit different, but those policies in many cases are not offered by employers, or when they're offered, they're not offered at the strength that you truly need them when something happens. And so what happens is there's disability before you're retiring, right? So you're not tapping into retirement income, but you need income because something happens or an illness strikes where you are considered disabled. So this insurance does definitely jump in those types of cases, just and works very similar to the other types of insurance that we just talked about. Again, here it is very important for you to work with a financial professional, whoever invited you today, and really understand how all of this plays into you specifically. If you're like me, you might be like, ching, 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 this is really expensive, I can't afford it, this is really expensive. But that's our job, to find out how we can march you towards your goals and objectives with your budget and map out the best program and plan for you. All right. Is Social Security disability insurance enough? I think everyone can answer this question. And we don't have an official poll on this. I apologize, but share with me if you believe Social Security is enough in your retirement or enough for your disability. Let me see the chat. Yes or no in the chat. Oh, we don't have people playing in the chat today, do we? Oh, we've got a couple of no's. There we go. I just needed to be a patient person, which sometimes I'm not, I know. Good. We all have a very clear understanding that it's not going to be enough for disability. It certainly wouldn't be enough for Social Security benefits later in life. It is wonderful extra income. I absolutely love that answer. And it's passive income. Haha. Yeah, I see that there in the chat. That's funny too. So we have to take control. If you remember on the agenda, it talked about us taking control and some of the conversation around taking control. We absolutely do need to optimize. We need to understand what's available to us. We need to make sure that's a part of the plan, but it's not going to be enough. And again, we need to take control over our own financial future and over our own security and protection. So disability insurance, it's really, it like the other coverages that we just talked about today, there's so much that happens in our lives where the insurances that may be that we have in place, like the health insurance and things like that, it simply doesn't take care of living. It doesn't put food on your table. It doesn't help you with your bills and your utilities. It doesn't help you if you have young children and how are you going to get care and those types of things. And so while the disability insurance through your employer does provide a portion of your income replacement, all of that other stuff, if you will, is not taken care of. And that's where disability insurance comes in. All right. So untimely death, I absolutely hate talking about this piece, and given the profession that we are in, this is something we absolutely have to talk about, right? And so what's the one thing that is a given in life is that we're going to lose it. We're going to die. It's going to happen. And when you think about death, you want it, you pray for down the road. I'm shooting for 110 years old, maybe 120, I don't know. But you want to make sure that if something does happen, what's going on with your family? What's going to happen to your family? Are they going to have a ton of bills that they have to take care of for you? Or are they going to have comfort and they can, you can replace your income and you can protect them, maybe even leave generational wealth? Because of the protection plan you have in place. And so you see the stats there. It is absolutely true. When you have families that are struggling to cover everyday expenses and the primary income earner passes away, just think about how devastating that's going to be, period, let alone financially devastating that's going to be. And my favorite thing is to work with an individual that believes they do not have the funding to be able to put the right level of life insurance in place, only to find out there are options for them. And so there is a big sense of relief. A lot of time there might be a few tears happening, but that is something that is one of my favorite things, is to show the way in order for families to be able to protect themselves and leave that legacy. I didn't tell this story back when we were talking about guaranteed income, but we had a couple just recently who just had some small 401ks. They're in their late 40s. The husband is in his early 50s, and these small 401ks, and they were living paycheck to paycheck. And so we were able to meet with them, and we were able to do a needs analysis, put a few budget strategies in place, move around some of the money that they were paying down loans and doing some things with their debts. And we were able not only to give them a guaranteed income stream that fits their budget for retirement age, but we were also able to solve for the life insurance need. So that is incredible when you see people's shoulders go, huh. And the wife did cry. And so I cried, she cried, we were all crying, but it was a wonderful story. But never have those disabling beliefs that you don't have the money to put the proper protection in place. That's for us to worry about, not for you to worry about. We are here to help you, hold your hand, and take you along your journey. All right. Okay, we've talked about this as far as life insurance. I just gave you a wonderful story. So I got ahead of myself there just a little bit. We're going to go through that screen and we're going to land on this one. So types of life insurance. I absolutely love this screen because a lot of times we describe it as the old insurance or the new insurance. And the old insurance is what everyone tends to know and just understand. Some people think that's the only option. That is term life insurance. So you're buying it. A lot of times it's cheaper. You're buying it for a very particular time of coverage. It could be 10 years, 20 years, 30 years, and then you're done. So all of those premiums that you have paid for that period of time, you're done. Some people have term policies in place. They're like, oh, I'm covered until I'm 95. Something to be careful with is that small print on your policy. What happens when you're 65? Do the premiums increase significantly? Does the death benefit decrease over time? Just really need to understand the terms of that term life insurance policy. And in many places, it can absolutely do the trick for someone. And again, we would just want to take a look at goals and concerns and make sure we're providing the right solution. In term coverage, some of the things you may want to look for are things like, can you convert it to what we're going to talk about next with this, which is permanent insurance? And when it terms, think about, what is your health going to look like when it terms? Are you going to be healthy enough to secure other life insurance? Typically not, because usually when you're taking out that policy, you're younger and your health is much better. So that's term insurance. But because of the cost of term insurance, it absolutely has the right, it can be a fit and it can be the right solution. But it's always looked at usually as step one. And then there's a step two, okay? And the step two can actually be your step one, not to confuse anybody, but the step two in a term policy situation is permanent life insurance. So permanent life insurance, it provides that lifetime coverage. There is no set term. You don't have to worry about it ending unless you're not paying your premiums. But you're not also worrying about those peaks in premium cost as well. There is a cash accumulation or cash value component to the permanent life insurance. And this is something that fascinates many people because they didn't realize, one, the growth is as significant as it can be in some of these policies, but that they also, it's not just a death benefit, but there's living benefits. And so many people are using this as wealth building tool because there's some tax advantages. We go back to the 401k versus the tax-free account, which was the index universal life insurance. That was a permanent insurance policy. So look at what happened with that young person that started saving at 29, retired 30 years later, and had full tax-free income till they lived to 100 and still had the benefits for your family. So we're putting into context now, that's a permanent life insurance policy. All right, here we go. Whoops, I got excited. Okay, we got that. We got that. I'm getting ahead of myself today. Look at that. So this comes to the question and takeaway portion of the session today. I want to thank everybody for joining us today, and I'm asking for two things. So those that are attending that are not team members, I absolutely want to hear some questions from you. But most importantly, I want to know, is there a takeaway from today's conversation? Is there something that you learned that you may not have known? Or did I provoke you to think about things just a little bit differently? Or maybe did I open your eyes to the possibilities when you might have thought this wasn't a topic for you because of your current financial situation? So share with me a question, share with me your takeaways, and if there are none, I'm not sure. If there are none, what we can probably do, Andrea, is we can end the recording and then we can have a little chat with the team afterwards. How does that sound? Okay, so takeaways from today's conversation. Let's hear those first. Drop it in the chat. Everybody here has probably some kind of takeaway. Other than maybe they learned to call it Wealth Wednesday. Maybe that's your takeaway. Okay, let me see the chat go. Come on, guys, drop it in the chat. What is your takeaway from today? Is everyone asleep? All right, I think everybody is asleep. I'm going to try not to take that personally, but that could absolutely be the case. I know sometimes financial services can be overwhelming, but I hope you enjoyed your time with us today. I hope you learned something new. If not, I hope we gave you some tips and tricks so you can think about developing your protection plan. You're not alone. Schedule a free consultation with the person that invited you. What's the worst thing that can happen? You can maximize your money, you can protect your family, and you can mitigate your tax exposure. And that's not awful. That's not worse at all. So thank you so very much, and see you next time.